JP Morgan will never be, they'll be the last because they're in the strongest position given their physical pile. But when they see the other banks get run over, and they get the okay from other sources, shall we say, to just let it go, they're sitting pretty. And my point is, regardless of what the timing and the trigger is, they are in a position now to benefit handsomely from a breakdown in the COMEX, the end of the failure of the COMEX, and physical metals to soar in price going forward.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today I'm excited to have David Brady back on the show. Former money manager, a contributor to Sprott Money News, now covers the gold and silver space. And hopefully you've heard some of David's past interviews on the show, because we always dig into some fun things today. In the past, as we will do again today. So, David, it's a pleasure to have you on here again. And how's everything going with you?
Great, Chris. Listen, thanks for having me on. I really enjoy our conversations. Looking forward to getting into this.
Well, it's always a lot of fun, and I think our whole audience, I don't like to say anybody owes anybody anything, but David, I know it's tough to pull you away because the Fed said the other day that they're going to start buying corporate bonds now. So I'm sure you were trying to get a bid in before the Fed takes over the corporate bond market. Previously, they had, I love the way CNBC phrased it. Previously, the central bank had been buying only ETFs, ETFs, corporate credit. I mean, would you like to make any comment about the Fed in the past week where they confirmed we will never see any interest rate under the dollar system ever again? And now this week, it's corporate bonds.
Buy the rumor, sell the fact. I'll say this. I've been saying this for, God, since 2017, 2018, but I've said it more consistently recently. The Fed is going to have to buy everything. I mean, this is a Ponzi market, left, right, and center. They know it, we know it. So, in actual fact, that announcement about the corporate bonds, while unsurprising, it followed on the heels of their decision to limit QE to 80 billion a month going forward on treasuries and 40 billion in MBS, mortgage-backed securities. That's effectively a taper, and you know that based on how the stock market reacted. Stock market went down. When you take into account the amount that the budget deficit is increasing by on a monthly basis, I think we're up to 2.5 trillion in the past 2.5-3 months. I mean, 80 billion in treasuries multiplied by 12 is close to 1 trillion. That's insufficient, and they're still talking about more stimulus measures coming down the pipe, which is no surprise, especially given that there's an election, I think, coming up in November. So the market reacted as one would expect. It's effectively a taper, and I'm not surprised by that either, because the market has run up dramatically, even though I said it would. In spite of what's happening to the economy in terms of the lockdowns and so forth. And it's corporate earnings and corporate earnings are horrible. They're going down along with the economy. PE ratios are at record highs, and yet the stock market is, almost back to all-time highs. The Fed is the primary driver of everything. So if they're tapering liquidity, it's no surprise that you would expect the stock market to falter. Now, I think we got to bounce out of that corporate bond announcement, but I think that'll be it for now, and we're going to head back down. And the S&P is on its way to, my target on the downside is 26 to 2,700. That's a pivotal level, and from there they'll unleash the floodgates again of liquidity, and up we go to new all-time highs.
Yeah, and David, I think my favorite part of what you mentioned there was that you said the Fed was tapering, and they're tapering now. What they consider tapering would put us with 80 and 40 per month. That puts us at a $1.44 trillion pace. So when the Fed's slowing down, it's like, all right, we'll only print a trillion and a half this year, which I'm wondering if you would say that what the Fed has done in the past year has any connection to, for example, I have a Tesla chart pulled up here. I see back in September of last year, right before those repo lines began, you had Tesla at about 200 and change, 225, let's call it. It's now at $983. As far as I've last heard, I don't think they've ever actually made a gap profit. Is this a good example of what happens when central banks run hyperinflation campaigns?
Yes, it is, and I'll try to stay away from conspiracy theory, but I'll give my view on this, and I'm not alone. I've seen other people talk about this. Quick comment on the taper issue. I say taper because yes, it's 1.4 trillion in total, but it's only 1 trillion with regard to government debt. Mortgage-backed securities, they somewhat support the housing market, but primarily the banks that are holding the mortgages, to be honest. So it's 1 trillion against a rising government deficit. But you have to put that in context of how much they printed in the past 3 months since March. What, 3 trillion? So saying that you're going to print another 1 trillion over the coming year relative to the 3 trillion you printed in the past 3 months alone, that equates to a taper. That's a definition of a taper. So the liquidity has dropped, and therefore, but you're right. I mean, we're talking ridiculous monopoly numbers these days. That's how ludicrous this whole thing has become. Now, people will debate, well, how are the mechanics working with regard to the Fed pumping stocks? Well, they're providing liquidity to the banks and the primary banks, and the banks are buying stocks. You just have to look at correlation is not causation, but the correlation between liquidity and the S&P since 2009 is just, I mean, it's too obvious to ignore. And what I believe is happening now is with the lockdowns in the US and globally, you're seeing small and medium-sized businesses crushed. At the same time, you're seeing a few stocks, 5 to 10 stocks in the S&P that are at new all-time highs. So what's happening with that liquidity? It's somebody is picking winners in this whole debacle that's unfolding in front of us. And it looks like Tesla is one of them. You've got Apple, you got Microsoft, you've got Facebook. And if you look at their earnings, Apple's sales have plummeted, yet their stock continues to go higher. So where is the liquidity coming from? You have to go to the ultimate source, is the Fed. And I think that the rationale for why a company such as Tesla, which to your point hasn't made a dime in its existence, and has only exists because of easy, low cost financing and easy availability of that financing. If it wasn't for the Fed, that company would have been bankrupt years ago. But it's still alive today. And then you see the other stocks that are benefiting from the liquidity. So that's what I think is playing out. They're creating monopolies in each sector. And this is where conspiracy theory comes in, but I'll just give my opinion. By creating monopoly corporations in various sectors of the economy, it's easier to control the economy from a top-down perspective because you only have to deal with 5, 10, 20 companies as opposed to 2,000, 3,000, 10,000. I think that's what's happening.
Yeah, it certainly is wild. I mean, it's like a lot of it. You almost you're like, did they really say that? Did they really do that? Some of this stuff is quite Orwellian. Although, David, now we got the foreplay out of the way. Now, I know you didn't expect that I was going to bring you on here and avoid. You knew I was going to ask you about silver today.
Yeah.
And I'm wondering if Tesla is $983 a share. Okay, here's a fun one, and you can pass if you want. I don't want to get you in trouble, but let's say that there was no COMEX. What do you think the price of silver would be right now?
$400, $500.
I mean, that works for me. For folks who might be hearing something like that for the first time and, not just taking it from the silver bug over here, but can you explain why you feel such a high number?
How long is the call? Okay.
You're on
First of all,
Silverbug Talk Radio, David. So you just let it flow, and I'll be happy. I would love to. If your answer to that is 2 hours, I will sit here and listen happily.
okay, well, let's start with gold. If gold is going to reflect the increase in the money supply in the US and globally, as Jim Rickards has pointed out, and some of his peers too, you're talking about a gold number that's somewhere between 10 and $50,000. And if you look at the gold silver ratio, which is around 100 right now, which is it's gone up as high as 110, 120, which is a ridiculously high, record high for gold and silver. Traditionally, the average has been in the past, I would say, 3, 4 decades around 50. You've seen spike downs to 30. The average through history has been 15 to 1. And actually, the amount of available silver on Earth relative to gold is 8 to 1. Now, we take into account that half of silver is used for industrial purposes, where gold is relatively not utilized in industrial practices. You take that half silver off the table, now you've only got 4 ounces of investable silver relative to 1 ounce of gold. And then markets tend to overshoot. They've opened, like, you look at silver, gold silver ratio as a case in point, it's overshot to the upside. Well, when a rally takes hold and these things take off, it'll be no surprise to see silver overshoot to the downside in terms of the ratio. Maybe it goes to 1 to 1. But let's just be conservative and say if we get a 10,000 price in gold, it may sound ridiculous, but not to me when you look at the data. And then say it goes down to 20 to 1 ratio. That means you got a $500 silver price, just that alone. Now, why would gold and silver take off? Well, we can get into, I've been saying that I believe hyper stagflation is coming, and I know Mike Maloney's been on this train as well, and I think Peter Schiff is on it as well. First of all, what do I mean by hyper stagflation? Stag refers to the economy, and the economy is slowing, to put it politely, right now. It looks like it could
Just a
crash.
touch.
Yeah, it looks like it could crash. If we get a second wave of COVID-19 lockdowns, you're going to see most, if not all, small and medium-sized businesses crushed, gone forever. So there's your stag. The hyperinflation part, and I've been saying this for quite some time now, that comes about, I believe hyperstagflation starts towards the end of the year. And the hyperinflation part comes out because while the economy is going down the toilet, you've got the Fed and global central banks printing money on steroids. Now, they may have tapered recently, but they're going to come back full blast sure, once the stock market drops a little here. So you got money printing going on, and then you're getting what I call supply shocks. And we've already seen this in gold and silver when premiums blew out in March, when many refineries around the world were shut down and many mines were shut down due to COVID-19 and the risk of spread. Well, you saw in meat recently as well when the Chinese closed down much of the processing plants in the US, Smithfield, which they own. And meat prices soared literally overnight from being at their lowest level in years. In the space of 6 weeks, they would hit a record high. Now, those were considered temporary, gold and silver. Oh, it's just logistics. That's nonsense. And meat, just temporary, and it's only limited to a few sectors. Well, let me ask you, what happens if they become permanent and pervasive? Supply shocks means that demand is being propped up by all this money printing in the form of universal basic income. We see it here in Canada in terms of child benefits, rent payments on behalf of the rentor, the payment to employers to keep their employees on. And you're seeing money dropping from the sky. So demand is falling as people are made unemployed, losing their jobs, etc. but it's been propped up by all this money printing. Now it's relatively small. It's going to get a lot bigger going forward. But on the other hand, supply shocks have only just begun. And this is where we get to, not a lot of people are talking about this, the escalation in the trade war between Trump and Xi over who released the virus and the control of information around the virus's fatality rate or contagion rate at the outset, and the lack of clarity from the Chinese initially. That's been the justification for a ramp up in anti China rhetoric in the US. Well, the escalation of the trade war, which is getting little headlines right now, that could be front and center here very shortly, because if tariffs go up on Chinese products, and there's two scenarios. They ramp up the tariffs on Chinese products and they'll devalue the yuan. But let's say Chinese products become more expensive to US consumers. So that means inflation has gone up. So they have to choose more pricier alternatives. Well, that means inflation goes up. And if Trump is true to his word and he could literally cut China off, I don't think he can do it in practice because we get a lot of our supplies from China. But if they literally cut China off and those products don't even get imported, then US consumers have to find more expensive alternatives. You think that's going to be limited to one or two sectors? This is the biggest manufacturing powerhouse in the world. That's supply shocks are going to become pervasive. So, cut a long story short, if you have demand falling, but supply of goods and services are falling faster, and I haven't even talked about the wave of bankruptcies that are coming here shortly. I expect a tsunami of bankruptcies. If you have supply of goods and services dropping faster than demand, Economics 101 tells you price goes up. And this is all while we were talking about the 3 trillion, the 2.5 trillion, 3 trillion that has been printed in the past 3 months, and the 1 trillion going forward. That 1 trillion is a joke, or 1.4 trillion. They're going to ramp that up once the S&P hits 2,700, 2,600. When you take the combination of those factors, to me, it just seems, this is just my opinion, I could be wrong, but it just seems obvious that hyperstagflation is going to be the result. Now, going back to your question, why do I think silver could hit 500, 400, 500? Well, if you go back to the 1970s and you look at what happened with stagflation in the US and what happened to gold and silver, gold rose 24 times in 6 years. That's 2,400%. Silver rose 36 times over those 6 years.
Yep.
Now, fast forward to today, and we get hyper stagflation, stagnant or recessionary, depressionary economy at the same time that we get Weimar Venezuela type hyperinflation. I mean,
it's almost like,
does 400, 500 silver sound that ridiculous when you take those two factors into account?
it's almost like if you put, it's like if I start smashing my hammer with a knee, it's probably going to hurt at some point. And if you suppress silver prices, add on leverage, and just keep doing everything to stuff the price possible, it's almost like what other outcome becomes possible?
Exactly, and the debate about manipulation of the silver market is redundant, and the precious metals market more broadly is redundant in my opinion. The proof is out there statistically, anecdotally, legally. You just have to go look for it. It's there. Well, let me say this: J.P. Morgan having the biggest pile of physical silver in the world, and it enables them to short at will because they're covered shorts because they're long the actual physical metal. But think about this long term from their perspective. If silver does go to 400, 500, 1,000, 2,000, $5,000, whatever the number is, how much money do you think JP Morgan's going to make?
You'd think if they have as much metal as alleged, it would be a lot. And actually, David, that reminds me of a reader question or viewer question, not reader. Someone asked essentially if these banks, or at least some of them, do have a big pile. Again, we hear a lot about JP Morgan. Do you think at some point they say, all right, we have enough, we're going to let the price fly? Why or why not? I mean, I know a lot of people have wondered that. Obviously, we haven't seen it yet.
Well, you could get into the rationale for why gold and silver are depressed. For me, they're the anti-dollar, especially gold. And what I mean by that is gold is a reflection of confidence in the dollar. If gold is soaring, confidence in the dollar, the reserve currency of the world, is falling. And so it's been maintained, the suppression policy has been maintained for many years because of that. And JP Morgan's silver pile enables them to suppress silver. But again, I think the trigger point becomes when the banks, and many banks have already exited, and the few remaining start to get run over. JP Morgan will never be, they'll be the last because they're in the strongest position given their physical pile. But when they see the other banks get run over, and they get the okay from other sources, shall we say, to just let it go, they're sitting pretty. And my point is, regardless of what the timing and the trigger is, they are in a position now to benefit handsomely from a breakdown in the COMEX, the end of the failure of the COMEX, and physical metals to soar in price going forward. That is something that ultimately they want. They will continue to play the game, if indeed they're doing so, I'll say if, as long as possible. But once the game is up, they win either way. And they're positioned to do just that. Just the same way on the gold side, the central banks are buying gold at the fastest rate in decades. Uh, why? Why have China and Russia? China is the biggest producer of gold in the world. Why have they been buying mines all over the world, buying refineries in Switzerland? Meanwhile, limiting any exports of gold abroad. So hoarding gold,
Yep.
and Russia too. Well, why are they doing it? Because they think they like shiny metals? No, they're doing it because they're hedging against the crash in the dollar. And for me, that's a foregone conclusion. And when that happens, and by the way, gold and silver, gold in particular, is already at all-time highs in almost every currency except the dollar. It's only a matter of time before it goes up to new heights. And when the rally in gold takes hold, and it won't be long now, I still see some risk of further downside here in the short term. We could get a 2008 spike in real yields um, because the Fed is tapering. But that aside, when the gold rally takes hold next time around, silver is going to crush gold. It's just going to catch up to gold and then wave bye bye to it on the way by. It always does.
I sure think that's going to happen again. I'm guessing there's probably a few people who are listening right now. Made them happy to hear that, as did I. David, last question before we let you run today. Um, Curious if you have any feel for how close to that break point we may be. Obviously, the timing is the one unknown so far in this whole saga. Although, on the other hand, it's interesting because a lot of the things you've discussed today are already happening now. I mean, we talked for years. You and I even probably mentioned last year, well, one day maybe the banks that are short think, gee, it's not a good time to be short the metals. And we've seen evidence of them reducing those positions, heading for the hills. I was also a little shocked to see that Davos, their theme at, you know what the theme at Davos was this year?
No, tell me.
They called it the Great Reset.
Oh, well, that's,
And I'll tell you
yeah.
what, the video, the little trailer they play, it's almost like, I wonder if CNN is like taking their news clippings from what these guys projected back in January, showing a lot of the stuff that's happened before it, it happened when it was recorded. So, I mean, sorry for the long tangential question there, but any thoughts on how close it might be till that day where we finally see the pricing of the metals reflect underlying reality?
Well, as I said, I'll answer that bluntly. October, November. Um, I'll give you the rationale for this first. So I said hyperstagflation is going to start to kick in towards the end of the year. We've got an election in November, and I do expect we saw the Fed just taper, which again was no surprise to me. But you'll see some pressure to the downside in stocks over the next 2 to 3 months. But then once the Fed has the market set up for another giant short squeeze, when everybody is expecting us to go down to new lows and the market's done, the depression has begun. I believe that's around 2,600, maybe even 2,400. You're going to see the Fed come back in a big way, break the dam of liquidity. And if you think we've seen ridiculous numbers to this point, you ain't seen nothing yet. I mean, 10 trillion is going to be bypassed pretty quickly. And then we're knocking on the door 20 trillion with regard to their balance sheet. At what point is all confidence lost in the dollar? But I think that happens in September, October timeframe, because there's an election right around the corner, and Trump wants to get reelected. So he's going to send Mnuchin over to the Fed and say, right, okay, now press the button. We need a much higher market. At that point, when they turn on the monetary spigots, what do you think happens to gold and silver? I mean, they're just going to explode higher. And it maybe start small, but by February, March, April 2021, up you go. With regard to your tangential question, with regard to the Great Reset, I'm on record for saying I expect the Great Depression to begin at 2023-24. And I've got my reasons. I don't want to say why on here, but 2023-24 is my target date for the Great Depression to begin in earnest. When the Fed is forced to pull the plug after, when hyperinflation, the QE does nothing but pump prices higher. Then they pull the plug, collapse occurs, Ponzi scheme over. Ahead of that, you're just going to see Weimar-like, Venezuela-like price increases, in my opinion. And when that happens, gold and silver have left the building. They're in the stratosphere somewhere. So with regard to timing, to answer your question, I think October, November is when the suppression is removed and up we go. I think it won't be long after that the COMEX is suspended or terminated, and the LBMA will have its own problems too. But that's the quick and dirty answer to that question.
Well, it's a pretty great answer. And if anybody, if I disappear for a couple of days and anyone wonders where I went, David, I don't know if you've heard this yet. My former futures and options teacher, he's a quant modeler. So we've been looking at a lot of option combinations around silver, and I'll be busy for the next couple of days calculating what the price of First Majestic silver might be with $400 silver bullion. Yeah, I mean, at some point, it's like they're going to blow it out, and they've made that clear. So while, a lot of the world might be experiencing a depression going forward, fortunately, the folks who were listening to your call today can at least be aware of what's happening, invest in the metals if they choose to do so. Again, I'm not telling anyone how to invest, but just sharing the information. So that way you don't have to be clobbered by this one when it unfolds. So David, I sure appreciate you sharing everything that you did today. And perhaps before we wrap up, you can just let folks know where they can find you write some great columns, and I know you're active on Twitter as well. And maybe you could just leave those links for us.
Yeah, sure. Just a quick comment for the folks, your listeners. My recommendation, to the extent that they can, because a lot of people are really hurting out there right now, is one of the reasons why silver outperforms gold in a bull market, be it in the 1970s or the 2000s, is because when people finally wake up to what's going on and start to lose confidence in the currency, they run down to the bank and they ask, hey, I've got $2,000, I want to buy some gold. And the banker turns to them and says, that won't even get you one ounce coin. And then they balk at it and go, well, what can I buy? Silver. Silver is called a poor man's gold for a reason. So to the extent that people can, just buy a few coins as insurance if you can for what's coming. In terms of where you could reach me, you can reach me at Global Pro Trader on Twitter. I'm active on a almost daily basis. You can also read my articles at sprottmoney.com. And yeah, I welcome any and all points of view. I can't keep track of everything. I wish I could. So I find Twitter a great tool in terms of people pointing out things that I haven't seen. So to the extent you want to reach out, please do.
Well, David, sure appreciate that. Appreciate everything you've researched and shared. And folks, if you'd like to know more about any of these things that are happening in the gold and silver markets, fortunately, David's Sprott Money counterpart, Craig Hemke, was on the show earlier this week. And if you want to catch that interview, it is coming your way now.